Okay, welcome back, everybody. Today's Friday. We're still working in Chapter 6, dealing with proprietary type funds. So, yesterday we got started in, or not yesterday, gosh, Wednesday, we started into Chapter 6 a little bit, wrapped up Chapter 5. So, let's just start with a quick review again, since we're out of the governmental funds now into the proprietaries. Once again, how many proprietary funds are there? There's two, right? Um, so what's the names of the proprietary funds again?
Enterprise fund,
Yep,
the internal service fund.
that's right. What's the main difference between the two?
Enterprise is to service the public,
Right.
and the internal service is to service the government.
Absolutely. So with that being the main difference between the two, if we were going to prepare government-wide statements, what type of activities would we place each of those in?
We would place internal service in government.
Governmental activities, right? Because it services the government, right? So it's internal service. Yeah, so it's governmental activities. Enterprise fund would be what type of activities?
Proprietary.
Right, but proprietary is what?
Business.
Business-like activities, right, right. So proprietary funds, obviously, the two of them are internal service. Enterprise fund, like you said, enterprise is outside the government servicing. Internal service is servicing the internal part of it. It's for a cost reimbursement, usually for internal service. It's for profit on the enterprise. But yes, when we prepare the government-wide statements, enterprise fund is used as a business-like activity, internal service, governmental activity. So, but they're presented the same within the funds, right? But government-wide, they're different. So just to point that out there. So good job. What type of accounting do they operate on, these proprietary funds? The accrual basis. So therefore they're worried about the economic resource measurement focus on both short term and long term, right? Stuff that's current and non-current. So the examples of enterprise fund, we'll just go ahead and pick back up where we were after we just talked a little bit about the overview of these types of funds. Remember, I think this is where we left off on Wednesday. Just some of the examples of an enterprise fund, like the water utilities, gas utilities, airports, bus systems, stuff of this sort, right? And it makes sense. And now after seeing this, bus systems, we know you got to get a bus ticket. Airports, you got to buy a plane ticket. You know, there's parking fees anytime you park in a garage, or if we drive on a road, we know we have to pay tolls if we're on a turnpike or something of that sort. So it makes sense why we're paying all these or fees, right? So these governments charging us fees. So it makes sense why these would be business-like activities, right? Okay, more with proprietary funds and the government-wide statements. Enterprise funds are business-type activities. They are included in government-wide statements without adjustment. So why are they included in government-wide statements without adjustment? What are they talking about there?
Because it's already accrual.
It's accrual basis, right? So because the government-wide statements operate on what type of accounting basis? Accrual. So there's no need to have that worksheet of doing the reconciliation between the two different standards. What type of funds do we have to do a reconciliation and change basis of accounting for?
The government.
The five governmental funds, because those are the only funds that even operate on modified accrual, right? The fiduciary, proprietary, and government-wide are all accrual. So that's why we don't have to make any adjustments. Internal service funds are generally classified as governmental activities because they service departments reported within the general fund or the general government. Either way you want to look at it. Their assets and liabilities are included in the statement of net position, and only revenues and expenses on outside sales are reported in the statement of activities. Okay? So it makes sense. So only stuff outside is what we report in the statement of activities, right? So that's a good little thing to remember there. So pretty much here, like we've already determined what this slide is here. Pretty much, enterprise funds, business like. Internal service is going to be your governmental activities, and we don't have to make any adjustments when putting them to the government-wide statements because they're already on the accrual basis. So next, this is a little just a little flow chart of what it would kind of look like when we start the fund levels and move up to the government-wide statements. This should look familiar. We've seen this in chapter 2, I believe, is what chapter we've seen this, but we're going to just go over it one more time because repetition is the father of learning. So we're just going to take one more look here. So obviously, if we look at the bottom portion here, we can see that the fund basis financial statements obviously is on the bottom part, and we can see they're separated between the governmental, proprietary, and fiduciary. So the fund basis financial statements for the governmental activities. If you see when we go to start preparing the government-wide statements, we need to change to the accrual basis from modified accrual. And then that is going to be accomplished through combining worksheet and journal entries, and we'll get to that later in the semester. But that's the process. Then ultimately it'll appear in government-wide in a full accrual basis. Same thing for the proprietary activities for the fund basis financial statements. You're going to shoot them straight up. They do not need to be adjusted because they're already accrual. The main difference there with dealing with proprietaries is just to make that distinction between governmental activities for internal service funds. As we can see here, internal service funds, you can see they have it split on the governmental activities, and enterprise funds is business-like activities. Lastly, we can see here that the fiduciary activities, the fund basis financial statements, it says that the fiduciary funds are not included in government-wide statements. Why is that again?
It's not our money.
It's not our money. We're just acting as a trustee, right? We're that third-party designee or the trustee, and the name gives it away. Fiduciary. That means that it's in a fiduciary capacity that we're just holding it as a trust. So obviously, if that's not part of the government's assets, we don't want to include them because it's going to distort the overall picture of the actual financial position and financial strengths of our government. So therefore, fiduciary funds are not included in government-wide. So once again, I'll just read this to the right after going through it. Enterprise funds appear in the business activities column of the government-wide statements, and internal service funds are most commonly included in the governmental activities column. And like I said, later on we'll get more into looking at these statements again as time progresses in the semester. Enterprise and internal service funds appear together in the fund basis statement. So that's really where we're just hammering down here, is to know that out of the proprietary activities or proprietary funds, it's not that hard to get into government wide. You literally just move your column onto the governmental columns, but you just have to make that distinction. And obviously, governmental, we have to make that adjustment and reconcile. So now let's talk about some bonds and enterprise funds. Okay, so we all know what a bond is, right? We issue the bonds when we want to raise capital for our government. So we know bonds is a debt instrument, right? We know stocks is an equity instrument. So those are two different things, but we're dealing obviously bonds. So this is a debt instrument. Two types of bonds. We have revenue bonds and general obligation bonds. Before we read into anything, I don't know if you have already or not. If you have, cool, it's no big deal. But can you just tell me, just maybe thinking of just the names of these bonds, if you can tell me the difference of what these bonds would be? We'll get into it. Obviously, it tells you right there. But just by looking at the name, can you think of what would be different? What would differentiate them?
Revenue bonds might be used for like a specific purpose, maybe to raise revenues to do a specific thing.
Think of it in a different aspect. Think about when we take on a bond, it's a liability, right? Think of it as if I come to you and I want to borrow money from you, okay, then I got to back it somehow, right? I'm either going to say, hey, well, I'm going to appropriate some accounts receivable, or I might assign some inventory, something of monetary value, right? Something that I have to back it with for you to trust me to give me that money, right? I gotta bring something to the table. So that's what the name of these is pretty much stating, is revenue bonds. If I come to you and say, hey, I'm gonna issue these revenue bonds, that's telling you that I'm gonna pay you back based upon us bringing in revenue, right? Back by revenue. General obligation bonds, That's going to be backed by the general obligation of the government based upon their taxing authority. So that's the difference between them. So we'll just kind of get into them. It says revenue bonds promise bondholders that enterprise revenues will be used to make payments. These are listed as bonds payable in the enterprise fund. Makes sense. It's their liability. They're gonna pay it out of there, right? It's their liability because they're saying we're backing that debt. But the performance of this fund is going to pay you back these bonds. So that makes sense, right? We're going to pay you back our debt with revenue, right? Because we issued debt, but it's a revenue bond. So it all means that's how we're backing the debt. We're with revenue from the enterprise fund. And then obviously on the flip side of that coin, general obligation bonds are going to be backed by the full faith and credit of the government, which is obviously the taxing authority of the government, right? Makes sense. Which do you think creditors would be more interested in lending money to? General obligation bonds or revenue bonds?
General obligation.
Why?
It's a bit more reliable.
It's secure loan, right? Because the revenue bonds are dependent upon the enterprise fund being successful, right? I mean, what if sales are down and what if people just aren't using these parking garages and aren't traveling and using these hospitals or whatever their sources, remember sources of revenue are, whatever they are, they might be down, so that might default. But the taxing authority, that's not going to default. People have to pay taxes, So obviously they're going to be more likely to give money, and that means or a better credit rating, so meaning a better interest rate, a lower interest rate, right? Because it's guaranteed that they're going to get that money back, less chance of default. Sometimes general obligation bonds, once again backed by the power of the taxing authority, are going to be used to finance enterprise activities, right? So we know enterprise funds can take those loans out, right? With the bonds, can issue bonds backed by revenue. But what this is saying is sometimes the enterprise funds will actually use the actual general obligation bonds to bring money into that fund instead of revenue bonds. And the purpose of doing so is going to be to get a better credit rating, a lower interest rate, right? So how do we report for this if that's what the enterprise is doing, just using the general obligation bond instead of a revenue bond? Well, if it's just for formality, meaning just to get that lower interest cost, but the enterprise fund's still going to pay it back. They only just pretty much, we're going to trick that bank, like, hey, give us, just to think of it, not necessarily, but say, hey, general obligation bonds, but we're going to still account for it in an enterprise fund as if it was a revenue bond and pay it back through that. And they'll just get it that way. That way they have a better way of getting a better credit rating. But they're still going to account for it within that fund, okay? Because it's their liability. Bonds are omitted from the enterprise funds only if the government agrees and fully intends to pay the bonds from other resources. So that's the only time it's not going to be an enterprise fund, is if the government says, "Hey, you know what? We got this. We're gonna pay it out of taxes, and we are fully committed." That is the only time you don't account for those liabilities within that. Makes sense. So why would an enterprise fund want to issue general obligation bonds as opposed to revenue bonds?
They're more enticing to people to buy.
Right, and plus they get a better rate, right? They're going to get a better interest rate, which ultimately will cost them less to borrow those funds. So let's talk about solid waste landfills, okay? So I think we know what a solid waste landfill is, right? Like where we go when trash trucks come and get our trash, they take it to the landfill, right? We know that, I don't know how familiar people really are with landfills. I mean, I'm not super familiar. I've never really worked at one or been a part of one other than just dumping some trash from time to time. And I know they smell awful. Have you ever been on one? They're terrible. I mean, they are so terrible. But anyway, so solid waste landfills, that's what we're talking about, is dump places where we dump trash. Well, we know that there is only so many units of trash or so many tons of trash that these landfills can actually sustain, right? And then they have to ultimately close them, right? We have to close them, and then have you seen them where they're closed? It looks like rolling hills, and they got those like PVC pipes coming out to let the gases breathe so it doesn't explode. So that's when they've been closed down. But there's post-closure costs, like beyond once the landfill's closed, there's post-closure costs that's going to be incurred, right? So this is what we're getting at with the solid waste landfills. So an enterprise fund might have a landfill, right? So if, like the city of Bluefield, let's say we have like the city of Bluefield has a landfill. Let's say they do. I mean, I don't know if it's within the city. I don't think it is. There's one over here going towards Princeton outside of Green Valley. There's one in the divides going towards Tazewell that way. I think they're both out of here. But let's just assume they do. And obviously, if they do, they're going to operate it through an enterprise fund, right? Because wow, when you go dump trash, they weigh your trash. They bill you for it, right? If you're not like a resident, sometimes residents can dump for free because they've already taxed you for it, right? So, but if you're a resident, you're already included. If not, you weigh it based on your weight. You pay the money, so it's by a fee. So obviously, it's going to be accounted for in an enterprise fund because they're doing it as for a profit, right? Well, what this is saying, as we operate these type of landfills, that we have to account for these post-closure costs, all right? So it says treatment of post-closure costs, and it's going to be on the accrual basis, okay? Cost of complying with environmental protection laws, got to love that EPA, after closure have to be estimated and accrued as a cost of operating the landfill during its life, okay? So we're going to incur these expenses during the life of operating this landfill while it's open, not once it's closed. We're accounting for it. We're actually going to incur the expense and set up a liability. So each year we have to set up an accrual, an expense accrual, okay? So we'll debit post-closure expenses, obviously, because it's going to be a post-closure expense. We've incurred an expense. Remember, expenses are like assets. They're original debits. So we've incurred an expense, and liabilities are original credit, right? So we've set up the liability for post-closure care. So now in that period, we've incurred an expense and we've set the liability, right? The way we go about determining the amount that we actually use for an expense is the units of production method. Do you recall what the units of production method? Or like when we get into like depreciation, that's just one of the depreciation methods. Or like, let's talk about depletion with natural resources. Have you all gotten into that in intermediate yet?
We mentioned it, but
which is it's pretty much the same thing as depreciation. Depletion is used for amortization, depletion, and depreciation are the same concepts. They tie to different items. Amortization is tied to what? Intangibles, right? Your intangibles are amortized, right? And also premiums and discounts are amortized, right? What is depreciated? Fixed assets are depreciated, right? And then natural resources are depleted. Same concept, because we're going to only get an expected useful life out of it. That's how we just spread it out over the life of that asset. Same concept. So we're going to use the units of production method, which is usually done with depletion or depreciation. And all that is the formula for that is going to be your cost, okay? Which there could be a salvage value, right? So we're trying to find the basis, which is the cost. That's your numerator. Your denominator is going to be the total number of expected units to produce, okay? And then you're going to multiply that by the number of units consumed within that period. So your fraction is going to be, the numerator is your cost, okay? So let's just say it's going to be, the cost is $10, right? And it's going to be over, we expect to get 100 units out of it. So it's going to be 10 divided by 100 times, and say we produce 5 times 5. That's going to give us our amount for the post-closure expense. Units of production method, not bad. Cost over the total units times what you consume. And that's how we actually get that monetary value. Not bad, right? After closure, as maintenance costs are incurred, obviously we're just going to debit that liability and credit cash. Same thing, right? I mean, the journal entries are easy. Cash is going out, liability is being reduced, so we have to debit the liability, credit cash because it's going out, right? So that's with the solid waste landfills. Main thing you hear, post-closure costs. How do we account for them? Do we account for them after the project or during the project? During the project, right. How do we go about determining how much we actually account for that post-closure expense? Units of production method, because we know that landfill can only hold so much. So let's say it can hold, like I said, 1 million pounds or 1 million tons, whatever it is. And it's gonna, whatever the cost is, there's the tons times how many tons been used. So that many tons has been used up. We know we can't use it. So therefore, then we have to count that as post-closure expense. Makes sense? And we do that on the accrual basis. We incur the expense in each period, set the liability up, and then once it's closed, as we incur pay those liabilities off, we reduce it and pay to cash. Main thing there is just remember those post-closure costs that have to be accounted for in each period during operation. That's the main thing. Solid waste landfills, governmental activities. Alternatively, some governments may operate landfills within governmental activities, so they can just operate it in there as opposed to an enterprise fund. Okay, so obviously, if they're going to account for it in governmental activities, the long-term portion of any liability for closure and post-closure care costs will appear in the government-wide statements of net position, right? Because the net position is like the balance sheet. So if we have that liability for long-term, it's going to have to be on the statement of net position on government-wide because that's accrual basis. Governmental funds operate on current financial modified accruals, so it can't be in those funds. But the periodic expense is recognized in the government-wide statement of activities. Got confused there. It's government-wide statement of activities. So if it's going to be governmental activities, it's going to be accounted for in the government-wide. The periodic expense statement of activities makes sense. That's our income statement, and the liabilities carried in the statement of net position because that's the balance sheet. Makes sense. So, how can a government account for a landfill? They could either do it in one or two ways. What's one way they can do it?
Units of production.
Well, that's how we come up with how much to charge for the post-closure expense that we incur in the period. But if they can account for how governmental activities or business activities. If it's a business activities, it's in what fund?
It's in business, then it's in the
enterprise fund, right? And if it's in the governmental one, then it's going to be accounted for in government-wide because it's on the accrual basis, right? That's the main thing here because it has to be. Recall it said accrual basis, so that's why it would be on the. Sorry, I'm just jumping all over now, aren't I? All right, so that's that thing. Post-closure cost. Might see something like that on an exam, but like I said, I'll give extensive exam reviews, so it won't be nothing, no surprises. Proprietary fund statements. So we have three financial statements here, right? Statement of net position, which resembles what?
balance sheet.
Balance sheet, right? Because net position, all that is assets less liability. So balancing where the position of the government or company. So statement of net position. Next, statement of revenues, expenses. Notice now expenses, not expenditures. So that's another way to remember that we're doing proprietary because it's back to expenses. So statement of revenues, expenses, and changes in fund net position, right? So obviously, a good way to keep up with that name right there, changes in fund net position. Obviously, the operational activities is going to change fund net position with expenses and revenues, right? And then lastly, statement of cash flows. And I want to point out and just tell y'all, this is the only two sets of funds that deal with statement of cash flow. That's it. It's not governmental, not fiduciary, not government-wide. Only proprietary. And thank goodness. I think statement of cash flows can be cumbersome and just kind of annoying to deal with, especially the operating section. The other sections aren't bad, but the operating can be pretty cumbersome. So it's three statements: statement of net position, statement of revenues, expenses, and changes in fund net position, and statement of cash flows. Statement of net position. Governments must classify assets and liabilities as current and non-current, right? So we're used to seeing that. So in other words, the statement of net position has to be a classified statement of net position, right? So what's classified mean when we say it's a classified balance sheet or a classified statement of net position? What are they referring to when you hear that?
You separate things into different classes.
Different classes. And the classes are what? Current or non-current. So you're just classifying it. That's all it is. Net position is reported within three categories: unrestricted, restricted, and net investment in capital assets. And in this case, restricted means restricted by external parties or by legislation, including legislation enacted by the government's governing body. What's the formula to get net investments in capital assets? You got it. What's the first thing we start with? There's there's three parts to the formula.
Take your capital assets
Right.
and
What?
take away depreciation.
Yep. Depreciation, accumulated depreciation, right? Yep. And then what else? What do we have to usually do when we buy capital assets?
Encumbrance.
Mhm. Think about it. Capital assets usually cost a lot of money.
Right. Debt.
Debt, but it's only what type of debt?
Uh,
Outstanding debt that's tied to those, right? So what's the formula for net investment in capital assets?
So, capital assets minus accumulated depreciation minus outstanding debt related.
Right, absolutely, and which makes sense because that gives us the net investment because we have to take out because if we have the capital assets, we know we're depreciating them, so we have to back that out to get the book value, right? The net investment, and then obviously if there's still debt out there and we still owe it, we have to back that out too because that gives us our net investment. So it makes sense if you really think of it. So if you get stumped on that, because I know when I was learning, I kept getting stumped on that. I would always leave out that outstanding debt. I just wanted to back out depreciation like that's net investment because I was so used to just intermediate and all my other classes. So just when it says net investment in capital assets, just let the name speak for itself. You already know accumulated depreciation is being accounted for. Just know there's one more element, which is the debt that's related to those and outstanding. So not bad, right? And then obviously it's going to have restricted, and then unrestricted is going to be the plug, right? Because remember, we're going to know what the whole fund balance is when we build it, but then we'll start with the net investment of capital assets, then we'll know what's restricted, and then the plug for the unrestricted will be easy to find. Okay, now let's get to the statement of revenues, expenses, and changes in fund net position. So this is going to be the format, and this is really good to know the actual formats here, because if you know the formats, then the statements are going to be a lot easier to build. Okay, just how we were going through, and we spent a lot of time when we were wrapping up chapter 5, just talking about the different items. How we were talking about, remember we were looking at like the other financing uses and sources, and we already know there's only 3 things that can even appear in that: transfers in and out, and an issuance of debt. Right, so we already know what to expect when we see that line item. Revenues, we know what to expect to see: property taxes, fines and forfeitures, stuff of that, fees, stuff of that stuff. So that's why the format is so critical to know. Journal entries and formats is so critical in knowing the elements that belong, and then the statements are easy from there because you know the format and the elements. So let's talk about this format. And once again, the name pretty much gives it away. The statement of revenues, expenses, and changes in fund net position. You just move in the order of the operation of the name. So first, we're going to obviously have our revenues, right? Just like any other P&L that we see, we start with our income. We have our revenues. From there, we back out expenses, right? And notice here that they're pointing out operating income, right? They're giving us a clean break here, right? This is very important. Operating income, just for this statement for proprietary: revenues minus expenses equals operating income. And the reason why it's so important to remember that you have to tell what operating income is and separating from non-operating revenues and expenses is because the reconciliation of net income from cash flows from operations starts with operating income when building the statement of cash flows, as opposed to net income for commercial sector. So that's why that's such a critical breaking point on the proprietary statement of revenues and expenses and changes in fund net position, is the operating income, which is not bad. It's an easy step to remember. It's just that's very important because when we go to build that statement of cash flows, that's a starting point when we reconcile the operating section. So we have revenues minus expenses, and we have operating income, right? So after operating income, then we can have plus or minus non-operating revenues and expenses, and then plus or minus capital contributions and transfers. Makes sense, right? From there, we have that'll give us the change in that position for the period. So that's all the activity that we're going to see within a period on these on these funds. Then obviously we add back beginning net position, and then we have ending net position. So the bottom of this is still the same. Remember how governmental they throw that reconciliation at the end because they want to see where they were they want to see the change, where they were in the beginning, and then ultimately where they are at the end, and it's all reconciled with the changes being stated above with all the operational stuff, right, and non-operating activities as well. So statement of revenues, expenses, and changes in fund net position. Remember, we start with revenues, we back out expenses, and then we have operating income. Remember, operating income is used to start with a reconciliation on the statement of cash flows for the operating section, okay? From there, we add or subtract non-operating revenues and expenses, add or subtract capital contributions and transfers, equals net change in net position, plus beginning net position, ending net position. Not bad, right? Not bad. And we're going to continue to go over this. That's why I just want to spend time on this, because the format and the journal entries that's 90% of the battle on these statements. I mean, it really is. So let's talk about the categories of the cash flows. If you recall, we mentioned earlier, we touched on this a little bit. There's 4 sections in the proprietary fund types for the governmental, under GASB. Under FASB, there's how many sections? There's 3. Remember OIF, operating, investing, financing. You also have, a change in accounting. On real sophisticated ones, you can get into change in accounting for foreign currencies and stuff like that, change in positions and cash flows on that. But for the most part, it's just your operating, investing, and financing. So there's 3 for the commercial type for FASB, right? FASB's cash flows have 3: operating, investing, financing. GASB has 4 categories. It's still operating, investing, financing, but for the investing, there's going to be 2, okay? Investment in capital and non-capital, okay? So let's see here. The operating section, interest and dividend revenue is not in this section. And that contradicts the statement of cash flows prepared following FASB, because if we know in the operating, we count interest and dividend revenue as operating income, right? So it's a cash flows from operations. Well, GASB's saying not here. It's not reported in the operating section, okay? Capital relating financing. I'm sorry, I told you wrong. Financing has 2 parts. Investing has 1, sorry. Capital relating financing. FASB statement of cash flows shows only principal payments on debt and financing, right? So if you remember that, only the principal. Obviously, if the interest payments and interest, all those elements are operating, the only thing that we deal with in financing section for the for-profit sector under FASB is the actual principal payments. That's it. Well, GASB's approach includes principal and interest payments here. Purchases of long-term assets are here, not in investing per business statement of cash flows. Because remember, on investing section of the business statement of cash flows, when you purchase and hold on to fixed assets or the proceeds of selling them, that's investing activities. Well, in this, that's not the case. It's going to be in the financing, the capital-related financing, which makes sense because if we're buying and selling fixed assets, it's going to be in the capital-related financing. The next section is the non-capital related financing. And this is going to be your short-term loans and repayments, including interest. So what type of activities do you think we would expect to see if we were building this statement in the non-capital related financing? What are some of the short-term loans that we've seen when dealing with some of the entries we've expected to see?
Short-term bonds.
Right. When we borrow, when we're storing cash, remember we might have payroll or tax anticipation notes. Remember those current tax anticipation notes and stuff. So those are types of activities that if we were building this, those activities will be put into the non-capital related financing, right? Because it's short-term loans and repayments, including interest. So that those type of activities. So when I'm just trying to just give examples of, like, when we see those examples in the journal entries and they hit the statements, those are what we're going to expect to be seen in that type of that category of the statement. And then lastly, we have the investing section. Investments and their associated revenues does not include purchases and sale of other long-term assets. So it's just investments and their associated revenues there. So pretty simple. So it's still operating, investing, financing. Just FASB throws us one more category of financing. And just remember, one's for operational or non-capital and one is for capital. So we're financing non-capital things, one we're financing capital things. Then we have the investing and operating. So FASB has how many categories for the statement of cash flows? And they are what are the three categories?
Operating, investing, and financing.
Right. FASB has how many categories?
GASB, that's it.
Sorry, GASB. Thank you. GASB has how many categories? 4. What are they?
Operating, capital financing, non-capital financing, and investing.
Awesome. Okay, so now let's get into a little bit more details of the two differences here. So we have the commercial statements on the left, which is FASB. Then we have proprietary fund statements on the right, which is the GASB. Okay. So let's start with commercial statements. May use direct or indirect methods for cash flows from operating activities. Do you remember that? You could use either direct or indirect there. One, if you use the direct method, you have to attach a schedule of reconciliation of net income provided from cash flows from operations. If you use the indirect method, then you have to provide a schedule showing your income taxes and interest. So that's the difference there. We have that option on commercial for the operating section, right? Because remember, if you recall, operating section, you have the option on commercial, and then investing and financing is built the same. But you have the option on the operating section. Well, that's not the case in the proprietary fund statements under GASB. They say you have to use the direct method. You don't only get the option, you have to use the direct method. Meaning, directly following the money going. If money's going out as an expense, it's going out as a cash outflow in the operating. Whereas if you remember the indirect method, it's more so backing out your accruals and turning them into the cash, right? Back to commercial statements. Interest and dividends received are reported in the operating section, right? They consider that operating income, right? Interest and dividend revenue is reported in the investing section under GASB. So that's kind of easy. That makes sense, really, if you think about it. The interest and dividend revenue is reported under investing, because when you think of interest and dividends, you kind of tie that to investments, right? So it's kind of easy there. Commercial statements, interest payments are reported in operating. Interest payments are reported in capital or non-capital related financing section under proprietary, which makes sense because interest is tied to what? Financing. So under GASB, if we're paying interest, then it's either going to be interest on non-capital or interest on capital financing activities. So it's going to be in one of those categories. So it makes sense, right? For commercial statements, purchases or sales of long-term assets are reported in investing. We already know that. If we're buying or selling fixed assets, it's going to be an investing activity for your commercial statements. For the GASB's proprietary fund statements, fixed asset transactions are reported in capital-related financing. Makes sense, because for capital, it's fixed assets, right? So it's going to be reported there. The reconciliation of income and cash flows from operations starts with net income under commercial statements, and it's the reconciliation of income and cash flows from operations starts with operating income under proprietary fund statements. So once again, you see now why it's so important for the statement of revenues, expenses, and changes in fund net position to differentiate the operating income from non-operating income, and it's because of that starting point right there with the reconciliation of the operating section. Okay, so how does FASB account for interest expense or interest received on the statement of cash flow? What category are they going to put that in?
We're going to put that in operating.
All operating for interest elements. Paid and received is all operating in FASB, right? For GASB, if it's interest tied to, let's say, a building, then where's it gonna go?
Interest tied to a building is going to go into financing.
Right. Which one though?
Capital
The capital one. If it's interest for non-capital, where's it going to go?
Non-capital financing.
No, you're right. You're right. Yeah, it's that simple. Yeah, I mean, I think GASB is almost more simple in a way. I mean,
I think it makes more sense.
It makes more sense. It really does. That's why I think the statement of cash flow is so difficult to grasp in the commercial side of it. And this makes it even more difficult because now you got two different standards. Because believe it or not, we can't let the commercial standards just go. That's still relevant in governmental. Why? Think back, because depending on what type of an entity we are, we either adhere to GASB or FASB. Remember, if we're private, like a government type of an institution, we're going to adhere to GASB. If we're like a for-profit or a public one, then we're gonna adhere to FASB. Remember, there's differences. So that goes to show you the importance, like, to even know what type of an entity has to adhere to what standards to be able to know what type of cash flows we build, right? So it is difficult. I think GASB's is a little more straightforward. It makes more sense with interest elements tied directly to where they belong and stuff of that sort. But it obviously, now we just got this whole big mess going on now, because FASB and GASB's telling us two different things, right? But overall, it's not bad if you really just sit down and think about it. If you know your categories and you just think about it from different, like why you're accounting for it different, like getting to accountability and just tying it to specific assets, it makes sense, really. So I think that's going to be where I stop. Let's just do a quick little review here, because this is all the content for proprietary funds. Obviously, we're going to deep dive in more. We're going to spend a few more class periods dealing with transactions to become more familiar, like we have with the governmental funds. But this is pretty much it in a nutshell. So we know there's two proprietary funds, right? We have an internal service fund, which is a governmental activity because it services primarily the governmental unit itself. We have the enterprise fund, and it's going to service the citizens or those outside of the government, and that's a business-like activity on the government-wide statements. We know that the financial statements for these funds is the statement of net position. We have the statement of revenues, expenses, and changes in fund net position, and then we have a statement of cash flows. Okay, we know that these funds operate on the accrual basis of accounting, the economic resource measurement focus, so that things are going to be current and non-current, right? We know that GASB has 4 categories under their cash flows as opposed to FASB's 3s. They're both operating, investing, and financing. There's just one more, financing, for GASB. They differentiate between non-capital and capital. When we do the reconciliation of income on the statement, we have to start with operating income for GASB. FASB, we have to start with net income. What else here? Solid waste landfills. We know we have to account for post-closure expenses during the period based upon the units of production method. I think that's pretty much a good stopping point here. So on Monday, we'll get into chapter 6. We'll start pulling those examples from the book and going through journal entries. Is there any questions about these proprietary funds? Anything we covered that seems really confusing or just not making sense to anybody? Everything seems all right? All right. Well, just remember, let's just take a glance here while I still have everyone. Just one more glance. We are in the week of the 17th through the 23rd right now. So Chapter 5 Connect assignments will be due Sunday at 11:59 p.m. And we'll continue in Chapter 6 next week. So we'll wrap Chapter 6 up next week, and we'll also start preparing for the midterm next week. And obviously the week after that will be the midterm, and that week we'll go over we'll have our midterm, and we'll have or get into our project details, which is 10% of our grade. My thoughts are we'll see how next week goes with getting through chapter 6 in the review. We'll probably have our midterm either Wednesday or Friday, and I'll get a feel where we are next week and see how we're progressing on the content, because I want to if we have to push back till Friday, we'll do so, but we should be able to hit it on Wednesday, and then who knows, we'll see, and maybe have an easy day Friday or something. We'll just see. We'll just get a feel where people are at. So that's where we're at. I just want to point out chapter 6 is our last chapter that we're covered. We pretty much covered everything that's going to be on the test now. Just need a little more practice on chapter 6, and then a review of the other chapters. And then we'll have the exam. So just remember, we'll have chapter 5 due this Sunday. Chapter 6 will be due next Sunday. And then we'll be getting ready for this midterm exam, which is 35% of your overall grade. So it is a big exam. So it is important. But I think everyone will be prepared for it. So that's it. If no one has any other questions or anything, that's all I have for everyone. Just remember to get that homework in, and everyone have a good day and a good weekend.